Hey everybody, hope everyone's doing well. This is the Emini review for Wednesday, July 3rd, 2024, and the market did close early today, but that doesn't affect the price action, so we're just going to do a regular review like any other day. Starting with the daily chart, we're in a tight trading range. We had that bull trend day yesterday. We're looking at the extended hours on this chart. If we were to look at the day only, this is what the chart would look like. There's more gaps. I just prefer to look at the chart that includes the Globex. So here's yesterday, this outside bull bar. And you can argue it's a bull bar high in the trading range, and it is, but the high of the trading range could be up here, could be here. You know that there's probably some more room to the upside. So while there might be sellers above, they may not come in until a little bit higher. So we have the momentum of a small pullback bull trend day yesterday coming into today. I also want to just briefly talk about a couple of thoughts on the weekly chart here. Today's Wednesday, so we're halfway through the week, but the market is closed tomorrow. And you can see we're breaking out above the highs of the past 2 weeks. They're both bad buy signal bars, probably sellers above. Tight trading range, sideways for 3 weeks. So I think there's an increased chance that Friday is maybe a bear reversal day or a bear trend day. There are sellers up here, maybe this bar, although it's closing near its high right now, could easily sell off and close near its midpoint. And then for the 5-minute today, always good to know the context coming into the day, which was a small pullback bull trend. We had these two big bull bars at the end of yesterday. It's a possible exhaustion gap. It might be enough, big up, big down, that the market converts into a trading range. But look at all the bars above the moving average. That's a warning. The market's still always in long, even if we do go sideways. The odds are the next breakout or the next successful breakout will be to the upside. Then bar one, we had a big bull trend bar, but possible second leg up, leg one, leg two. Probably sellers above here, big up, big down, probably a trading range. The bulls still need follow through after bar one, but some bulls will buy the close, front running the breakout and entering a little early. And then we got bar two, an inside doji bar, so that's disappointing for the bulls. The bulls wanted for the minimum follow through, they want the absence of a bear body, but instead we have a doji with a bear close. So a lot of traders, if they did buy, they'll look to exit at break even, maybe at the close of bar one, or maybe above bar two. Bar two is a bad high one. And then bar three, we went a little more sideways, consecutive inside bars, so II pattern, breakout mode, probably sellers above bar three. And the odds are we'll test below bar one. The odds that bar one remains the low of the day is about 20%. Bar four, we're breaking out above really all the bars to the left, but only closing above these two bars, 2 and 3. We closed at the high of bar two. It's a small second leg. The bulls were expected to get a second leg after this breakout, maybe two-legged pullback, then a second leg. But the bulls who bought here are disappointed. This is a tight trading range. It's probably sellers above. And then bar five, we had an inside bear bar. There's been no pullback since below bar 79. So we have a micro channel since bar 80 yesterday, no pullbacks. But these are implied pullbacks when there's tails below bars and bear bodies. So some traders see bar 5 as a second reversal. Bulls might exit and bears might sell for a scalp. There's an increased chance we get a deeper pullback. Then bar 6 rallied. We tested the low of bar 5 and then rallied. But what do you notice about bar 6? It might be 1, 2, 3 pushes up. Also, going into the close of bar 6, you have to keep in mind that bar 7 is often a report, and that's what we had today. And then obviously bar 7, that big outside bar, which just tells you the market is likely in a trading range. But in this case, look at the pullback after the bar 1 breakout. Here's the open of bar 79. We never closed that breakout point. So even though we tested it several times, it's acting as support. The market's having a hard time getting much below it. And the bears did not close that gap. So there's an open gap on the line chart. So even though 7, it's probably more sideways trading to follow bar 7, but really tight bull trend, tight bull channel. You can trade in both directions, but what Al says, tight bull channel, only want to buy. So for me, better to look to buy pullbacks, buy below bars, and then exit above bars. Inside bar, bar 8, really small bar. So we had an IOI pattern here. Range expansion on bar 7, and then range contraction on bar 8. Trading range price action, consecutive dojis, probably sellers above and buyers below, bar 8. And then outside bar on 9, more trading range behavior. Bar 9, you can call it a high 1, but it's probably at the top of a channel or a trading range. It's probably more sellers above bar 9. What I will say at this point, since bar 1, looking at today only, the selling pressure is really weak. The bears have 1 bar, that's bar 5. We triggered the high 1 above bar 9, and then reversed down. Bar 10, bear, reversal bar. There might be sellers below for a scalp. It might be 2 or 3 legs up, plus maybe high in a trading range. But again, I mentioned the moving average earlier, and I want to mention it again. This is a 20 gap bar, 20 moving average gap bar setup, where we've had at least 20 bars above the moving average. So what do you think will happen when the market comes back and tests the moving average? The bulls have been buying. When the market's above the moving average, it's expensive. So the bulls have been buying above the average price. So the bulls will be happy to buy at the average price when we get there. Follow through on bar 11 for the bears, but it's a relatively small bar, tight trading range for the past 5 bars. There might be more buyers below. Bears might just scalp out. But you do have the moving average, which could be a magnet as well. And then this is where bar 12 vacuumed down to. And I see bar 12 as a vacuum test rather than a strong breakout that I expect to get follow through. One of the reasons for that is the context. You look back and is this enough, this 3-bar breakout? Is it enough to undo all of this? It's really not. It's hardly a trendline break, if it even is a trendline break. It also didn't close below the moving average, didn't close below bar 7. These bars have a lot of overlap. So to me, it's a vacuum test of support, and you're expecting those bulls to buy the moving average. Now, maybe not ideal to buy above bar 12, 3 consecutive bear bars. The bulls might wait for a second entry. But for the bears here, the bears who sold up here are probably scalping out at the moving average. We made that big trend bar on 13. 2-bar reversal, reversing bar 12 completely, so that's a problem for bears. The bears are hoping this is leg 1 and we get a second leg, but because this is a minor leg down for the bears, it's a problem. You also have the outside bar on bar 9, and as crazy as it seems, bar 8, bar 9, and bar 12 could be 3 pushes down. Maybe we're reversing up from a wedge bull flag at the moving average in a bull trend. So not ideal to be looking to sell in this context. 13, strong enough to disappoint the bears. If there is any second leg, maybe we test the bar 12 close, but I do expect the downside to be limited and will probably continue higher. It looks sideways, but again, bar 12 did not close the breakout point, bar 79 open. That's a sign of strength for the bulls. This is a bull channel. 14, a doji. Disappointing for the bulls, but for the bears, they see it as a low one at support. And if we do trade below 14, it would be a second leg down, testing support after the bears were disappointed. There's probably buyers below 14. In a bull channel, traders are buying below bars, and buying a low one at the trend line or at support, like this breakout point, the moving average, buying a low one in this context is where the bulls are looking to buy. But instead of going down there, traders bought the close of 14, and then we rallied on 15. It's a 4-bar micro channel, but comprised of a bear bar and a doji, not all that strong. We'll probably pull back before very long, but this doji could be the second leg the bears got. Leg 1, leg 2. Probably buyers below 15. That is now the low 1 signal bar. Continuing higher on 16 consecutive bull bars, not all that big, and testing resistance. We're testing a price where bulls just got trapped, so there might be disappointed bulls here looking to take profits. And then 17, a bear bar, probably due to bulls taking profits. What about selling below 17? It's a double top, maybe high in a trading range. It might be, but again, just look at the moving average. It's one of the most sort of simple but effective filters or indicators. When's the last time a bar closed below the moving average? It's all the way back here, somewhere over here. Maybe this bull bar, this bear bar. But the point is, we've had many bars above the moving average, and every reversal here on the way up has been minor. So what are the odds that this turns into a major reversal? You sell below 17, and you get a measured move down, break out below the neckline, bar 12 low, we come down here. Well, the probability is pretty low. We haven't had a trend line break yet, and whenever there's a bull trend, we're still getting open gaps. What does Al say? With a major trend reversal, you first need to see a trend line break, preferably with good momentum, which would be, see if I can find an example, just because today's video is going to be pretty short. Alright, here's one. Here's a bear trend. Not all that many bars, but it's a good enough example. Here's a bear trend, here's the bear trend line, and then the bulls get all these consecutive bull bars, uniform in size, not that much overlap, pretty good breakout, but it's still minor at this point. But it's a big enough minor reversal that the retest of the trend's low will probably form a lower low, a double bottom, or a higher low, and then the bulls will attempt to get some sort of double bottom major trend reversal. So we get this trend line break. That's disappointing for the bears. Major trend reversals are basically a low one on a higher time frame chart. So this was an extended, pretty much an endless pullback. And then when we retested the lows here, you can see we rallied again and ultimately got a major reversal. And the reason I show that is because we're not getting that today. What's happening today is minor. So it is a double top. Where were we? Here. So it is a double top. But reversal patterns, what does Al say about reversal patterns? It's better to think of them. Sorry about that. What I was saying is that you can think of reversal patterns as continuation patterns. Sorry, I kept having to cut there, so I forget what I was saying, but I know it was something like 80% of trend reversal attempts fail. So when you see a reversal attempt, like a double top, in a fairly tight bull trend, it's better to think of them not as reversal setups, but as trend continuation setups. So this is more likely a minor reversal. There are probably buyers below 17, scaling in lower. Inside bar 18. You could argue the market is in breakout mode. Maybe it's a triangle, but it is an overall bull trend. So the probability favors a bull breakout. Inside bar, so reduces the probability for breakouts. Likely that any breakout will lead to a pullback before very long. And then 19, a bear breakout attempt, but immediately reversed back into the apex of the triangle. 50% chance the first breakout of a triangle goes the wrong way. So maybe we had a bear breakout which reverses into a bull breakout. The context makes sense for it. Bull breakout bar 20. Good for the bulls, but they still need follow through. But for now, the bears not really getting what they need. And then 21, breakout and follow through, these two bars. There's a tick gap from the close of 20 to the open of 21. Decent looking bull breakout, tight bull channel. Certainly always in long, only want to look to buy. So it's okay to buy the close of 21. 22, more follow through. Consecutive bull bars, 3 or 4 bar micro channel. But the bull bar getting smaller on 22. We're testing resistance where bar 7 rallied and then reversed. We're getting a breakout attempt of that price on 22. And then 23 looks like profit taking from the bulls. But again, even though it's a reversal bar, this is a tight channel. The odds are any reversal will be minor. Probably buyers below. Maybe at the breakout point, the bar 17 high. So maybe we reverse, or maybe it's a breakout pullback. We test this level and then find support. 24, small bear trend bar, but still probably minor reversal, which means traders are buying and scaling in lower. They know, even the bears know, if the bears are selling, maybe they sold above this price with a limit order and they're looking to scalp out. Some of the bulls missed this breakout. They know the odds are it'll get a second leg. They'll buy a pullback and then hold for that second leg. So 24 consecutive bear bars, but probably a minor reversal and just above support. Not ideal to be selling. 25, we have a third consecutive bear bar. You can see we tested the support, fell below it, but then closed just above it. It's a bad stop order signal bar above 25, but the context is okay. But some bulls might prefer to wait for a high 2, so above 25 is a high 1. We triggered the high 1 and immediately failed. It pulled back. But now 26 is a low 1 sell setup at support in a tight bull channel. So probably more buyers below 26. Outside up 27, bulls bought below. Any bear who might have been short probably taking profits below 26. And then we had an outside bar 27. Still not a very strong stop order, but now traders will see it as 2 legs down and a stop order high 2 above 27 for trend continuation. Inside bar 28. Inside bar just means the range is contracting. It's typically a triangle on a smaller time frame chart, so it's actually a nested triangle. And the market is going from a wider range to a more contracted, narrow range, which just means it's in breakout mode. And we still have open gaps. You can see breakout points. These bear bar opens are not being closed, so we still have bears trapped, and they provide fuel to upside breakouts. At some point, they have to buy back their shorts. 29, bull trend bar. That's a problem. If you're a bear, let's say you sold anywhere. There's a 2-legged pullback in a bull trend. You see a bar like 29. That's a bar that always in bulls, if they exited for any reason, can get in again above, and bears will exit above. Continuation, so breakout follow through, 30. Little overlap on the bars, and fairly uniform in size, 2 points and 2.25 points in a bull trend, so it's always in long. You can probably buy the close of 30. More follow through, 31, you can buy the close. What about, is it 3 legs up? And is it a wedge? The problem with counting legs with trend, like counting the bull legs in a bull trend, especially when you still have open gaps and when the channel is fairly tight, the problem with doing that is you'll inevitably start seeing all sorts of wedge tops, and they just lead to minor reversals. It happened here, lots of pushes up, but then ultimately we got a minor reversal and then trend continuation. So that's my concern with here. I don't think it's unreasonable for bulls to take profits in this area, or if there's a bull breakout attempt of this channel line, it's reasonable to take profits, but to bet on a major reversal is a mistake. And it's all, again, because the moving average is a great indicator. You can see it's a tight bull channel, still no closes below the moving average, not enough overlap or selling pressure, no trend line break. So this is, if anything, going to lead to profit taking and a minor reversal. $32, another bull bar. So we have 4 consecutive bull bars and a micro channel since 27. The odds are the first pullback will be minor, and there's probably buyers below all these bars. 33, bull breakout of the channel line. The bulls still need follow through, and typically it's a 25% chance when you get a breakout of a channel line, 25% chance that the market accelerates in this direction, in this case to the upside, and goes into an even stronger bull trend. The probability in this context, maybe it's a 35% chance that happens. It's not really 25% chance when the market is bullish. The one concern I have, though, coming into the day, you know we're probably going a little higher, but you also know that the market is in a tight trading range. There's probably sellers above. So you don't know when that's going to be. So not unreasonable to take profits on 33, but nothing to sell. And then 34. So think about a bear who was front running the wedge. 1, 2, 3. Maybe they sold above 32 or somewhere on 33. They're getting trapped right now. This is a breakout and follow through with a strong follow through bar. This is a very strong bull breakout. Can you see it as 3 legs up? Sure, you can, but the reality is this is probably a leg count reset, and this is leg 1, and it should get a second leg. Any pullback will be minor, and there's probably buyers below. Finally, a disappointment bar for the bulls on 35. It's a doji. It's from profit taking. It always goes back to the trader's equation. Bulls are buying all the closes all the way up, but eventually they have to contain their risk. And at some point, the bulls are buying up here, and if you're long up here, theoretical stop is down here. Here's your 1-to-1. That's a big distance. And so naturally, what the institutions do, the best way to reduce risk, because you can reduce your risk in 2 ways. You can move your stop higher. So if your stop is down here, you can pull it higher, or you can reduce your position size, which means take some profits. That's what's happening on 35. The problem with just pulling your stop is there's not as much of a mathematical basis to it. You know that this is a strong enough breakout. There's buyers below. So if you pull your stop to maybe just a little below a 50% pullback, somewhere like that, it's kind of a skunk stop, and you're probably selling out of your longs where there's buyers. But disappointment on 35. Bulls probably taking profits. They'll probably sell above this bar, sell the close of 34, 36, an inside bar. It's a high one, but late in a rally and possibly late in a bull trend. So not ideal to be buying above 36. It's also a little parabolic. There's a little bit of acceleration here on 33, 34. getting further from the moving average, as you can see. This is an area where bulls will take profits, but it is still expected to lead to a minor reversal, not a major reversal. 37, everybody sold the close of 36. We had that disappointment bar. We retested the close of 34, and then everybody sold. Now we have a decent bear bar on 37, but it's the first decent bear bar in a long time. So some bulls will see that and use it as a signal to buy. You see the first strong bear bar in a while, and you buy because the market's in a tight bull channel. Strong breakout, the odds are it'll get a second leg. 37 might be strong enough for its own second leg, but even if a bull did buy it and there's a second leg down, it's still minor. You can buy more lower, scale in, and you'll probably get a second leg to the upside. 38, immediate disappointment for the bears. High one above 38, but enough sideways, we might have to pull back a little deeper, and the bulls might not be willing to buy up here. They'll want to buy lower. So 39, we didn't trigger the high one, but everybody sold, and we have a bear bar closing on its low, but 2 legs down. Maybe we get to the moving average. Maybe we test this breakout point. There's probably support here. It's also right at the moving average, so a couple of reasons to expect support below 39. 40 went a little lower, testing both of those support levels, and then bouncing. 40 is not a good signal bar, but the context is okay to buy above it. But if you do, you need a good entry bar. And it's not ideal because you're buying in the middle of this bull flag. Better to buy lower. And then a big bull bar. 41, a little bit of a surprise. Leg 1, pullback. Climactic, leg 2. Some traders will just take their profits on the close of 41. It's a big bull bar. And possibly getting late in a trend, a little climactic. Is this a measuring gap or an exhaustion gap? We're not really sure at this point, but it could be an exhaustion gap. And then no follow through or bad follow through, 42. Disappointed bulls buying the breakout, disappointed with 42. They'll probably look to exit. I know we're getting late in the day. I forget exactly. There might be 45 bars today. So there's an increased chance we just start to go more sideways here. Inside bar, 43. High 1, but after a bull breakout and disappointment, probably sellers above. And then we triggered the high 1 and found sellers above, but a very small bar, lots of overlap for the past 3 bars, probably buyers below and sellers above. And yeah, that was it for the day. So just sideways into the close. It's common to go sideways after climaxes. And when you get a buy climax, what you're expecting is 1 to 3 bars sideways, and then depending on the context, either continuation or a reversal. So especially in trading ranges, if you get like a second or third leg and it's a climactic leg, you'll get 1 to 3 bars sideways, and then it's more common to see a reversal. In this case, like bar 1, sort of a climactic bar, but in a bull trend, you go sideways for a couple bars, and then you continue higher. So for always in today, it's always in coming into the day, even with these bear bars, 79.80. It's still an overall bull trend above the moving average, open gaps, so always in long all day, and no reason to really. There was no major reversal today, so if you're trading always in, you can probably buy the close of 1, and then there's really no reason to exit. And if you do exit for any reason, you buy above a bull bar, closing above its midpoint. For stop orders today, I thought it was okay to sell below bar 10 for a scalp, and that's an aggressive trade because you're trading counter to the direction of the trend. That's not a trade that I would specifically recommend. And then probably buyers above 13, 2-bar reversal, pull back to the moving average in a bull trend. And really, you can buy above any bull bar. Over here, there's a high 2. You can buy above 28. Not a good signal bar, but the context is good. Maybe you wait for a better signal bar, 29, buy above a bull bar, closing on its high, and then you can buy above or on the close of any of these bars. And then you get disappointment, you exit on the retest, 36. It's a high 2 above 40, but like I said, not a great signal bar. 41 was a surprise. And then for limit orders today, it's a bull channel, so you have traders, bulls buying below bars and taking profits above bars. So coming into the day, bull breakout, sideways. It's a micro channel all the way up, so buyers below 6, which happened on 7. 7 was big enough of an outside bar to expect more sideways, buy low, sell high. So probably sellers above bar 8 for a scalp. Buyers below 7, but we didn't get there. They came in at the moving average. Micro channel here, buyers below 18, inside bar, and bull micro channel, and the context was good to look to buy. And then you could buy below 23, but there's breakout points, sort of obvious support levels that might get tested, which they do here. That's a better limit order buy. Buyers below 26, low 1 in a bull trend. And then you can, again here, you can buy below 36, maybe scale in lower, but it's a sort of climactic rally. Bulls get disappointed. Far from the moving average. You might get a deeper pullback. We got 3 legs down. So there's probably traders buying below 37, especially after the bull bar, 38, thinking that it's already 2 legs down. If we fall below it, it'll be a 3rd leg down in a bull trend after a strong rally that should get a 2nd leg. And then I mentioned this high 143, probably sellers above, but that's also a scalp. And where do we go Friday? I kind of touched on that a little bit. I think the market's high in a tight trading range and consecutive bull bars, but bad context. We still haven't had a breakout above the trading range. Actually, I guess that's not true. Let me see. So the high of this trading range is 55.88, the high of that bar, and the close of today was 55.95 and 3/4. So we do have a bull breakout. The bulls still need follow through. What do we know about breakouts and trading ranges? 80% of them fail. So it's possible. Some traders might see this as leg 1, pullback, 2nd leg trap. High in a trading range, you can expect bulls to take profits and aggressive bears to start selling. So Friday, maybe we have an early reversal, maybe a bar 18 reversal to the downside. Those are my thoughts, but we'll see what we get. And then as always, please feel free to leave questions in the comments and include the timestamps for any question specific to this video. All right, hope everyone has a good rest of their night. Thanks for watching.